Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Ogti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
Hi, my name is Aaron Ogti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey, Aaron, great to be here today, and thanks everybody for listening.
Great to be here as well. So today, Trish and I are going to talk about socially responsible investing and kind of a subset of that, ESG investing. ESG, I believe, is environmental social governance investing. And we're not trying to kind of come to any broad conclusions, but really just having an open conversation around the idea, is it worth it? Is socially responsible investing worth it? And we don't even have a really good definition for what that means to be worth it. But we're going to start there, and I think we have a couple counter thoughts that might go back and forth. We'll see how the conversation goes. So, Trishul, do you want to start us off? Just a quick primer. Can you explain the idea? What is socially responsible investing and ESG investing?
Yeah, the high-level notion is investments in general have a profit motive, and the main point of investments is to provide or to maximize value for shareholders. You may have heard, similar terms in the past. And when you think about that, it's really about doing anything you can that's legal, I guess, to grow wealth as efficiently as possible for the owners of the business. Often this means it's the shareholders, right? If it's a public company. And that profit motive is kind of key above all else. So that's typically how businesses are run. And there's some understanding that if businesses focus on maximization of profit, then overall the business will do well over time and whatnot. However, there's this other line of theory that businesses are these big entities and they have big impacts. And when we're putting our investment dollars to work, there might be something else to think about beyond just profit motive when you're choosing a company, and that's where socially responsible investing comes into play. The idea there is there may be some ethical understanding of why one business may be a better business than the other beyond just profit, right? There might be some sort of sustainability involved within a business venture. For example, it might make sense to put dollars towards a renewable investment versus a carbon intensive producing investment. All else being equal, right? Or even at the slight detriment of all else being equal. That might be part of the calculus. But the notion is there may be beyond just profit things to consider when making an investment decision. So that's where the umbrella term of socially responsible investing comes into play. And then just to kind of define it, one category of that is ESG. So that's specifically focusing on non-financial factors of a company in terms of their environmental impact, their social impact, and the governance, how they're basically governing themselves. And again, that there's ways to help understand this and help inform decisions about which companies are doing better or worse. We have a spectrum here across these various attributes. And perhaps an individual would rather invest in companies that do better with respect to pollution or have better standards with respect to human rights issues or do better in terms of providing better pay to their employees or have a broader diversity among their board members. So these are all things that we might look at. So that's the high level.
Okay, so if I was to go look at like an ESG fund or an ESG ETF? Do you know kind of, or like, I don't want to have to choose the individual companies because I have no way of judging, like, are they even a good company? If I'm trying to invest in a company that is good for the environment, I'll go, but I can't judge that myself. I have no way of judging that. So I'll go with some kind of some other either manager, or in this case, because we're not doing active management of boards, I want someone to have some kind of screening function for me. So I'm going with a ESG ETF. Do you know kind of what that might be looking for?
Right. Yeah. So, in terms of how you might actually implement such a strategy, yeah, you can certainly pick a company that you think is doing a good job and research it yourself, and check out what's happening behind the scenes. Read up upon them and check out their reports and their annual reports and their marketing and all of that. However, it can get pretty complicated and pretty taxing. So there's a few things that happen. One, the actual stocks themselves can be ranked based upon their ESG, meaning how well do they perform based upon other companies relatively in terms of their environmental impact, their social impact, and their governance. Or you can outsource completely to a mutual fund or an exchange traded fund where you basically are paying an extra fee for managers to do that due diligence for you. And that's kind of hammered into the expense ratio of those products, such that their job is specifically to source high quality firms that meet this mandate and build a combined pool of these companies in a wrapper like a mutual fund or ETF. And yeah, you would just basically outsource that work to them.
Okay, so I think I might need to clarify, because my understanding is that there's two ways to do this. Like, even if, assuming we outsource it to an ETF or a mutual fund, and we'll then choose it. One is they're going to try. So it's an ETF. So it's trying to mirror an index anyways. They're trying to be as passive as possible. They're trying to, say, match the S&P 500 with, or a total stock market ETF, but trying to do it in a socially responsible way. So my two understandings: one, they'll try to rank companies within a category and only choose those that are more socially responsible. So they're not going to exclude oil companies, but they will kind of rank the oil companies in terms of which ones are slightly better for the environment among oil companies and which ones are slightly worse. And so there's the oil companies that are reinvesting in some kind of renewable energy, that are also building wind farms. Like, there's something else that's more than that. So it's not that it's going to just exclude oil companies, but they'll try and rank within a category of, among all the oil companies, here are the slightly better ones when it comes to environmental protections and forward outlook. The other form that I can think of when it comes to these types of ESG ETFs is that they're just going to exclude companies that derive, and I'll derive revenue from production, supplying, or retailing things like weapons, firearms, nuclear power, fossil fuels, tobacco, alcohol, gambling, adult entertainment. So it's like they're just going to exclude those categories completely. And so that you're not going to be investing in any companies in those industries. And you might kind of have a lot of tech companies. So like, you might have still Google, or what, Alphabet, Microsoft, Facebook, or that's now Meta, Amazon, and like, you might have a series of tech companies, but like, these tech companies could be bad for the environment or bad from a social perspective because there's no kind of internal ranking of their activities. So like they might be, it's weird to think of like a tech company employing child labor outside the country, but like it's because it's not in their industries to be excluded, it could have some other negative ramifications. Can you think of anything else, like when they think of like how to construct these ETFs or how they're doing their analysis of, is this a good ESG or SRI company?
Right. So I think there could probably be any flavor of option out there depending on what somebody is going for. For example, if they're looking for a product that marries or that closely follows a broad index, like the S&P 500, but like you said, it either excludes companies or weights companies depending on their ESG rankings. That's certainly an option, and that'll give you good diversification, and it'll give you something that has a pretty high, we would call it like a pretty low, for example, tracking error to the S&P. It'll move very similar to the S&P, but it'll again fill more of these non-financial goals of yours. So I certainly think those products are there, and there are likely other products that really zero in and focus on sub areas within the broad market that provide even more focused ESG investment styles. For example, they might just focus on renewables or companies that specifically just no matter for a particular industry that do very well on being socially responsible, and so on. So I imagine there's pretty much anything, if you can probably think of a product, it exists at this point.
That makes sense. Yeah. So like, yeah, kind of like how ETFs have drilled down from not just your international ETF and your emerging markets ETF. You can actually, there'll be an ETF for any specific country. If you think this particular country is going to outperform, you want to invest in companies that are coming out of Thailand, but not companies that are coming out of Japan. That like you can choose, you can get that specific. Same thing applies to the ETFs, where you can choose the specific style or flavor of those, kind of how you want to be socially responsible.
Right. And there's probably also a spectrum on how discretionary are those decisions that these managers are making. Some may be less discretionary, meaning they may just take this ranking that's formulaic and translate that to an actual investment decision without a human intervention. Or you may have, on the flip side, something that's very actively managed, where you have actual humans doing on-the-ground research on these companies and really kicking the tires and making sure that what they're saying they're doing aligns with their mandate and whatnot, and really trying to pick like the cream of the crop ESG subset firms that do really well with what they say they are trying to do, and just invest in those only. So as there is a flavor for a particular style of just ETF, there is likely an analog flavor for that style of ESG investment or SRI investment.
Yeah. Okay, so now we're going, like, assuming that we are going to go with some kind of ESG investment, but I don't like looking through company financials, and I'm going to kind of outsource this like scale or ranking or judgment to some kind of ETF or mutual fund, which they need to add some layer of expense to cover just that extra screening. There's more work on their part, so they need to get paid for that. So the expense ratio is going to be a little higher than it is for just the cheapest ETF to get the S&P 500. So now, kind of getting back to our initial question, like, is that worth it? And so, like, how do you even start to think about that question?
Yeah. So here's how you might think about it. You might say, okay, well, maybe there's a line of thinking that these companies that are ESG responsible are actually better companies, meaning they're more thoughtful, and maybe that means they'll do better. So when you're comparing their actual performance, maybe you're not even giving up performance by investing. I'm saying maybe because you can't see my air quotes too well, but it's hard to say. But one line of thinking may be, oh boy, I need a a synonym for maybe. One line of thinking could be that when you invest in ESG, you get about the same performance or even better. So that could be rationalized from one perspective. And it's a big question. And let's say it is better, then it's kind of a non-brainer or no-brainer, sorry. But the other notion might be maybe it is a bit worse. However, maybe somebody is willing to give up some performance with the understanding that, hey, I'm doing something better. I'm giving up performance, but the world's going to be a better place because I'm putting money to work with companies that are more responsible. So I think either of those lines of thinking could be substantiated, perhaps.
Okay. So I guess because we are choosing something that's not the S&P 500, it's like I don't want to call it active management specifically, but it is something like we are taking the S&P 500 or the total stock market, kind of the pool of everything, and we are excluding some companies and choosing others. So there's some level of decision making. And I guess I'd say we would be happy with the idea that after fees, we matched the S&P 500 or match whatever benchmark we're trying to mirror. Because if we would kind of got the same return and we invested in the companies that we felt were better for the world, that we're providing kind of we get some kind of positive benefit from that style of investing, and we haven't given up anything. So that would be kind of our minimum successful strategy, I guess I'd say, where we got the benefits we wanted and it didn't cost us any kind of opportunity cost. It didn't cost us anything on the downside. So then the next question is, okay, well, the fees are higher, so can an ESG make up for the slightly higher fees? Is that possible? And let's say maybe we can't. Let's say we got the same gross return, but because the fees are higher, that we're giving up some percentage to invest in these companies. So we're getting kind of, now we have a trade-off. We're giving up the cost of the higher fees in exchange for trying to help the world in some small way. The next level would be, okay, let's say we're choosing companies that because they aren't those true ruthless profit maximizing companies, they just don't generate the same returns when we exclude them. And so are we actually willing to give up gross return to invest in these companies so that we are trying to help the world and we're willing to give up some of our money in the form of foregone growth to be able to help make that small change? Or then the possibility, like, do these companies, are they, because we think they're better run companies and maybe don't take on certain risks, and because they're more sustainable and they're more likely to be good long-term companies, that over a long enough time frame they actually could outperform? So it's kind of like, if it's they can outperform even with the higher expense ratio, Okay, that's great. Let's just do that. Let's help the world and make more money. That's an easy decision. If it's same net return, also easy decision. Okay, I don't mind paying this company a little bit extra if they're going to generate the same return after fees. So then let's look at those other two where we're getting the same gross return, but ESG investing has higher internal fees, or we actually get a lower gross return. How do we start to think about, like, is that worth it?
Right. So I guess I'm going to put myself in one of these camps. I think you'll likely end up in the latter camp that you mentioned, where most likely you'll end up with a return stream that could be similar at best on a gross basis to what you might get by going non ESG. But once you factor in the fees, you'll likely do worse by roughly the amount of fees you pay to implement this strategy.
Okay, why do you think that is?
So the reason boils down to just an understanding of efficient markets and applying that to this situation. For example, let's start with a premise that ESG companies actually perform about the same or even better than regular companies in terms of how that business grows. And again, that there is reason to substantiate these. These are companies that are trying to be more innovative and conscious about environment and social issues. So they're trying to be forward thinking. So maybe they have a leg up on a company that's thinking a little more backward. So that company should, or that company, it seems, might have a leg up over time that could compound and benefit that firm. However, the point I'd like to make is, even if that was the case, that doesn't mean that stock will be a better performer. And the reason is because if everybody knew that ESG companies did better, those companies' stock prices would already be pushed up by that understanding, such that that extra benefit would already been sucked out of the company by being reflected in the current market price of that firm. So something like that, I don't think could persist over many long periods of time. So at best, I would say an ESG company on a gross basis, meaning if you're not outsourcing, right, would probably do about the same as a non-ESG company on a pound for pound basis, just based on how efficient markets operate. And the reason I think they might do worse when you're paying a manager is, well, that manager has to be compensated. And there's plenty of other research, we've talked about this before, that actively managed funds tend to underperform by the amount that they end up charging to investors. Meaning they roughly get about the same return on a gross basis. And once you factor in their fees, they do worse by the amount of their fees. So the higher their fees, on average, ends up being the lower their after-tax or their after-fee performance.
Okay. So I get the logic. Kind of like any time that you are adding in some kind of cost and or restricting potential opportunities for revenue, that the possibility for underperformance is there, and if nothing else, you could just be adding costs and generating the same revenue, so your net after fees will be lower. One of the things that I kind of question, it's not a perfect analogy, but that idea of, okay, if ESG companies can keep up even after fees, that efficient capital markets will allocate the money towards them, kind of drive up their price so that the future returns again become match the broader market. And I don't think that capital markets and kind of those capital flows work quite that efficiently. Because when it comes to kind of non traditional ways of thinking about companies, I'm trying to think of like the best way to phrase that. Like looking beyond just balance sheet or just metrics that are measurable. This is one area where capital markets have done actually, I don't say that, definitely haven't done an optimal, efficient method of allocating capital. And the example I think of is companies with female founders. This is kind of looking at more private equity and venture capital, but there's some research that female founded companies can outperform male founded companies. And it's hard because there's so fewer, and so you get into kind of sample size issues of, are the female founded companies the ones that are persisting are just standing out versus a significantly larger number of male founded companies, and so kind of the average is going to be lower. So that's a possibility. But even given this some evidence of this, women-led startups still only receive about 2% of venture capital funding, somewhere between 2 and 3% depending on the year. So venture capital, like, they have seen evidence that female-founded companies can outperform male-founded companies, but they still receive a significantly lower amount of the VC funding. Again, there's just aren't that many female-founded companies, but it's a lot more than 2%. So there is some evidence that even shown outperformance, there is a preference or bias for capital and funding to go towards the kind of traditional ways that things have been done, and reluctance to invest in kind of newer ideas. And so one, kind of, do you want to kind of discuss that idea of the logic in my analogy related to women-founded companies and the funding that goes towards them? So that kind of analogy, because I know it's not great, but two, do you think that also applies to the ESG side? And do you think that is a possibility that people allocating funds to ESG companies aren't assuming that they're kind of are going to be extra profitable, and so are less likely to kind of maximize that and try to drive the price up to match the returns?
I think what I would say is I'm a bit skeptical for a few reasons. I think it's very possible that sort of correlation exists that you mentioned with the female entrepreneurs and CEOs. However, if that correlation was found and it was, something that's highly robust and persistent, it seems almost too easy for the professional investors to say, hey, this has been published, let's put it to work and let's arb it away. Like that was, a good part of my job for many years as a hedge fund manager. The idea is we look for these patterns, and they often start with a theory that's been tested that has a rational basis. It's not looking for, spurious correlations, but something that makes sense, just like the one you mentioned. And our job is to bring those ideas into production, right? Put it to work and put money behind it and then scale it up. So, for example, even on the ESG side, I'm reading this in real time, so
Okay.
let's hope it supports something sensible here. But anyway, I'm going to just read it. It says ESG investing may lead to high returns. So that's what this article from NerdWallet is positing. A 2019 white paper produced by Morgan Stanley Institute for Sustainable Investing. Okay, who's funding this, by the way? It's like the dairy farmers pushing dairy, right?
Yeah.
Compared the performance of sustainable funds with traditional funds and found that from 2004 to 2018, the total returns of sustainable mutual funds and exchange-traded funds were similar to those of traditional funds. So what they're saying is, on an after-tax or an after-fees basis, this period, they were about the same. So that's actually against what I said before. So, the final sentence of this paragraph is, other studies have found that ESG investments can outperform conventional ones. And, my response to that is, you're always going to get studies saying this particular theory makes sense. Right? You'll find there's always going to be one time period where that's true. And, if there's 100 time periods, half of them may support it. Right?
Okay.
So, the notion is, if it was, I always like to think, if investing was that easy, if it was that easy to outperform, we'd all be rich, which is impossible.
Okay, so I acknowledge what you're saying. Both I'm trying to think of the kind of how to phrase this question. I agree that if there was a way to get that consistent outperformance, it would be arbitraged away, kind of over enough people. I also agree that kind of, was it wider perfect a little bit? It's kind of statistics we talked about, like just the odds we get some, if they're close enough, it's a 51-49 kind of coin flip. The odds that over a 100 flip sample, you might see a streak of 10 to 20 where the 49 wins out. Especially like kind of, you're going to get some streaks like that. And in fact, it's almost, I forget the numbers I see, but it's like, if you don't get a streak of, I think, at least 8, like something's wrong with the coin. Like you're almost expected to get a streak of 8 if you flip it 100 times. Like it's more likely to get a streak of 8 than not. And that could be the in play here. That like just ESG investing hasn't been around that long. And so we don't have enough of a sample size. Like, is it actually able to outperform, or is this just we happen to be in the time period that it has? I guess I would ask, do you agree with the premise that there is some bias in investing?
I agree. Yeah, my response to that is usually, yes, there's a bias in investing. Yes, markets are efficient. However, no, I don't think it's that easy to identify that bias and make money off of it.
Okay. So I think there's been many articles about, like, given evidence that female funders outperform males, why don't they receive more funding? So I don't want to go kind of into that level of conversation or have you make that guess. Do you agree that my analogy could extend to the ESG investing side, that there may be some bias against ESG investing?
Bias again?
Yes.
See, it's interesting. My mind goes back and forth. For example, with the female CEOs, that's a little different because we're not talking about publicly traded companies. We're talking about, for example, venture funding and private equity, and these are other spaces that are more susceptible to bias, right? Because there is less of an active market there.
Okay.
And I can see how those types of biases may persist more easily in those spaces than the ESG space for publicly traded companies. For example, part of my thinking with ESG might be that, if people are buying ESG because it's the right thing to do in terms of a fad, they might be driving up those prices inadvertently beyond what they should be, so that they actually end up being a worse investment. And you can see this back and forth that might actually play out in the markets. And they, the final resting spot may be some of the times they'll do better, some of the times they'll do worse. You average it out, and I think you still might get something that's about the same.
So I guess. So now I'm doing like a quick Google search. I'll make sure to include the list. Like, do female CEOs outperform male CEOs when it comes to like stock price? And I think this almost gets to the governance side, where like more diverse boards of directors, I do think outperform homogenous boards of directors.
Now, are we saying the company outperforms or the stock price?
I'm not sure how to tell the difference in our conversation.
Well, see, the distinction is the financial company may be doing with a better governance, right? Financial company, or sorry, let me say this properly at least. So companies with better financial governance might be doing better in terms of their growth. This is their fundamental growth. Like their incomes may be improving more steadily, their revenues may be growing against the competition. However, their stocks may be still performing in line with the companies that are doing poorer on the governance. Because if people know that companies that have better governance do better, then the prices of those companies would be driven up, so that there wouldn't be a benefit to investing in them.
Okay, so so I'm trying to think. This is like, if they are, so it's all, like, it almost gets back to that. I guess. Okay, so maybe like fundamental question, like, what does it take for a single stock to outperform the S&P 500?
Right. Yeah. For the actual stock to outperform the S&P 500, something has to happen to that company that was unanticipated in a good way. They need to beat earnings expectations, right? They don't need to have good earnings, because if everybody expects good earnings, then it's not going to do better. It needs to have better than expected earnings.
But that, okay, so I can see that makes sense over a shorter time frame. But like, how would it outperform over a 10-year period?
Yeah, so consistent. Well, a few things. Just it more often than not, it needs to beat expectations than not beat. If that makes sense, right?
Well, actually, now that I think like the way the math works, like, it really only needs to
do it once.
Yeah, exactly. You have to outperform once and then meet expectations every other time.
Sure. Yes, that's true.
Like you get that one jump and then it like tracks exactly the same for the rest of the time frame.
Yeah. What that also means is whoever got in right before then did better.
Yeah.
Whoever got in right after that did the same as the market.
Yeah.
Right. So,
okay.
if you're investing
go
over
on.
many years, you need to, and you want a company that consistently outperforms, they need to consistently beat expectations.
Okay, so this like gets back to just investing's hard. Investing's both like really, really easy and also insanely impossible. So like you said, like you have to buy it before that one period of significant outperformance. You can't buy it after.
Yeah, you have to buy before that good thing, that unexpected good thing happened.
Yeah. And so I can see like even if um female CEOs of public companies had their stock prices outperform public companies by male CEOs in the past, it doesn't necessarily indicate that they'll outperform moving forward. Like, because it's possible like the outperformance has already been priced in.
Yeah,
that's interesting. Okay.
And what the female CEOs would have to do is they would have to do even better than people expect, knowing that they already do better.
Yeah.
And that's exponential, right?
Yeah.
So that's why things like this are very hard to persist. The ESG companies not only have to do better if they are supposed to do better, right? But they have to do better than that even in perpetuity. Not possible in my mind.
I totally came into this conversation expecting to convince you. I think you may have changed my mind a little bit. That just like that past performance does not indicate future success, like whatever the phrase is. I don't want to say like I'm admitting defeat, but like I haven't, like I feel like I've made more of a logical change than you have. And yeah, it comes back to like acknowledging the very realistic possibility that you could get underperformance. Is it still worth it to you to be that small agent of change?
Mm-hmm. Well,
and that ends up being more of a personal decision.
It does. I would say for that, as I had mentioned, your underperformance will likely be correlated to how much fees you pay for these types of products. So, from that perspective, I'd say if you're interested in going down this path, probably go down it with the understanding that you want to pay less fees to get this done than more fees.
Yeah.
Like, for example, there are lower fee options in the ESG space. There's also robo-advisors that have jumped into ESG, like, the Betterments, the Wealthfronts, and whatnot. And, rather than an actively managed mutual fund or ETF, that are, okay, so on the NerdWallet article that we'll link, they had a few examples of ESG funds. I'm gonna randomly pick the first one.
I did the same thing. I picked one up. There's a Vanguard ESG US stock ETF. Has an expense ratio of 0.09%.
Okay, so there you go. You can get it done for a low price. The robo advisors are doing it for 25 bips.
But that's the
This
same
one,
thing they're charging for everything.
yeah, so it's not that much more. And if they can do it for, a similar fee, then you may not be giving up too much. I haven't looked at any of these performances. Well, okay,
Yeah.
I'm looking at the one from NerdWallet. Okay, this is an actual fund, mutual fund, which I'd say, avoid. The fee here is between 0.9 and 1%, so it's pretty heavy. And it's been around for over 20 years, going on 30 years. And okay, so here's the performance over that period. Over that period, this fund returned about 50%, the S&P 500, 800%. I don't even know why they put this in the article. Okay. Let's try the second one.
So yeah, I'm just trying to see if I can get a Vanguard ESG US stock ETF and compare it to. Looks like it's an all caps. Probably compare it to the Vanguard Total Stock Market Index.
Right. Okay. So this one, another ETF. All right. The first one, I guess, in case anybody wants to check, the ticker was SSIAX. It's called the 1919 Socially Responsive Balanced A Mutual Fund. Again, that one did pretty miserable over 2 decades. The next one is the PAX Large Cap Fund Institutional. And again, I'm just going to pick 2. We don't need to do all of them, but this is the first 2. This one's only been around, according to this data, 1, 2, 3, 4, about 4 or 5 years. Over that period, it's up about 30%. The S&P is up about 90.
Yeah. Yeah, like time frame matter. Like when I'm looking at ESG, the Vanguard ESG US stock ETF compared to the Vanguard Total Stock Market ETF, the 3-year ESG is 13.05 versus the VTI is 12.42. So like there's a 0.6 outperformance over 3 years, but it looks like there's been a negative 3% over the last year. So that the ESG is underperformed. It's a negative 10 versus a negative 7. So over the last year. So yeah, just like it depends on timing because the Vanguard one only has an inception of 2018. Yeah, it's the same thing every time we talk about investing.
Yeah.
It's you just but anytime you're trying to compare investments, like time frame matters. You get the randomness within any 1 to 3 to 5 to 10-year period. Like something can outperform for the last decade and then underperform for the next decade. So just keep your fees as low as possible.
Yeah. The ones, for whatever reason, that made it to this NerdWallet article, the fees are between like 0.7 and 1%.
So those sound like actively managed funds.
Yeah. So as we had mentioned, there's different styles, and these are more active. They're paying people more money to make better decisions that are likely going to deviate more from a more systematic approach, whereas Vanguard is likely following a formula. That's why the fees are roughly 80% less.
Yeah. So for me, I guess this kind of I've never really brought this up to clients. I don't advocate for it. Like I've talked about, I really love using direct indexing strategies, especially at SCI. And SCI does have a good like ESG screener where there's a 12, 15, 20 different screens that you can add to your portfolio. So like if you don't want to own any tobacco stocks, it can screen out those. If you don't want any alcohol, gambling, like anything we talked about, it can screen out any of those. So it can screen out fossil fuel companies. And so for clients who have some kind of ESG preference, we can add that in, but it hasn't been something that I've actively brought to clients. I was curious, like when it comes to practice, do you have any clients that have come to you asking for some level of ESG? Have you had those conversations in your practice, or is just you never bring it up and clients never bring it up?
Yeah, it might be more of the latter. But having had this conversation, I would say if a client is um, geared to make this type of investment, I'd say what we've said is sensible. If you can get something that makes you feel better, but the fees are low, then it may not be so bad, especially if the fees are quite low. The other thing I might say is, instead of subsidizing one of these funds, you might even still go down the index route for like the S&P or whatnot, and put that differential that you might be paying in extra fees into actually supporting the causes that you care about, whether
Oh,
it's
I see.
environmental or whatnot. Yeah, that way it's not a subsidy to the managers, because that's where that money is going when you pay for the ESG fund. That's where the fees go, right?
Yeah.
But rather, it's you can have a payment directly to a foundation or some sort of nonprofit that's geared towards this type of thing.
Yeah.
Like
So
one example that I was looking to recently. Let me see if I pull up the company. You may have heard of this. It's a way of neutralizing your carbon footprint, where you can buy carbon credits and stuff like that to offset your environmental impact, right? The company is Ren.co, and you go through a little formula and it calculates your footprint, and it tells you, here's your environmental impact based upon your lifestyle. And then you can buy credits that actually go directly to nonprofit firms and other capital requiring firms that will help institute actual changes to offset your impact. And the amount you pay in fees and extra fees is probably more than it might be to actually just neutralize your carbon footprint.
yeah. So if like extreme easy math case, if you have $100,000 and the difference between the ESG fund and the non ESG ETFs is 1%. Like we'll go from 1.1 expense ratio down to 0.1 expense ratio. So I can do math in my head. And you're just paying an extra $1,000 in fees. You're saying just go with that lower one and take that extra $1,000 and invest it in that like Ren.co or something, like the cause that you feel is most important, the cause that you want to support.
Yeah, it's a little interesting, Aaron. So $1,000 divided by 12 is $83 a month, and my Ren footprint was $79 a month.
Like it's like for the but that's the cause that matters to you enough to look it up.
Right.
For others, it may be like, how do we get more females in leadership positions at companies?
Right. Yeah, I would say it's a more targeted approach, which I think might have a more meaningful chance of having an impact. Because, at the end of the day, my other personal impression is okay, it's great to invest money in, for example, solar companies be above the coal companies. However, my personal feeling is, well, the solar companies will get the money because they're better companies.
I see what you're saying.
So, but by giving them even more money, right? And you're not actually giving them the money. You're buying the stock from somebody else who is not the solar company, right? If it's publicly traded. So it's not like they even get that extra money per se. I mean, it's a little more complicated than that. But my point is, if you really care about a cause, it might be better to just cut the check.
I think I first heard that phrase from Charles Barkley talking about paying athletes, something like that, going back to basketball. Just cut the check. Okay. Unfortunately, like, would not surprise me. I think that I don't want to say you convinced me to care less. I'm trying to think of how to phrase. Like, I appreciate that I don't, like, I've put in the mental energy into our conversation, and I don't need to put in too much more mental energy after this. But I don't know if you've convinced anyone listening. I don't know if I've convinced anyone listening either. I think that, like, it starts to wade into that, like, irrational, non-logical thought process of the people who were investing in or continue investing in it, people who weren't probably aren't. So, like, a good hour conversation and nothing really changed, which feels on par for us.
Well, maybe if somebody takes away one thing, if you're going to do this, do it for lower fees. Maybe
that's a pretty consistent message from us. So again, rightly on par.
Right. We'll keep those fortune cookies handy for
pay less, save more, invest in equity index funds, pay lower fees.
Right.
Okay, this is good. I appreciate. I was not expecting for you to kind of like change my mind that way, so I do appreciate it. I totally thought it was going to change your mind.
Well, I always grow from these conversations, so my mind is definitely always changed, and it is this time as well.
Okay, well, thank you very much, Trishul. I really appreciate it.
Thank you, Aaron. I appreciate the conversation as well. And if you're listening and enjoying these conversations, do spread the word. And thanks, of course, for listening. Okay, bye.
Bye. We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.